18th of August 2021. Just a very quick update from me regarding one or two conversations I've had recently relating to hedging techniques, and a question that's been asked a lot over many years, I suppose, as to how we can make money or protect our gains if we see a tumble in the market. It's very difficult to change this mindset, but I think historically everybody tends to think, and naturally so, that if the market's going up, we're making money. If the market's going down, we're losing money. And what we've been trying to sort of educate, I suppose, over many years is this notion that we can avoid that belief system by applying certain more advanced methods of investing and understanding the maths of how this is involved. So what I'm going to do initially is I'm going to pick the most recent trauma that we considered, and that was in March of last year. So what we're looking at here is what's called a candlestick chart. The red and the green candlesticks are showing on a daily basis the movement of the market. In this case, the SPX, which is a proxy for the S&P 500, the biggest US market or exchange. And we've got over and above the candlesticks, the green and the red. Red is a down day, green is an up day, and it shows the range on that particular day. This is March of last year, and we're looking at two other proprietary signals and lines that we use to gauge entry and exit points as part of a number of other statistical overlays and inferences that we would also consider. So in essence, and I'm going to break this down into very simple terms, if the dark blue line cuts the lighter blue line, or green line, is that perhaps a cyan line, then that would indicate that the market is likely to be trending downwards. Equally, if the dark blue line cuts the lighter green line or blue line on the upside, that would suggest, and remains above it, that would suggest the market's in an uptrend. So if the big darker blue line is below, downtrend; above, uptrend. As you'll see here, this was quite near the peak of the S&P 500, and here in March of 2020, when the COVID outbreak really started to rattle the markets, the S&P 500 was at a level of 3,329, and it got down here to a low of about 3,185 as a sort of rough idea. That is a massive move to the downside, a colossal move. Now, following these indicators, we would not have been in the market here, and we would have waited until confirmation of the change in trend had presented itself. And from a mathematical point of view, we were not then thinking, should we be in, should we be out? The numbers told us, based upon history, based upon an enormous amount of data collection and analysis, exactly when we should have been in and out. So this is one example of how we can use sort of rudimentary maths to decide on entry and exit points, both on the upside and the downside, to cut out these kind of black swan events and these big catastrophic moves that cause a lot of pain. Now, admittedly, the market post the COVID crash did recover, but psychologically and emotionally, it was a traumatic time for anybody investing in normal retail investment funds. A lot of people saw 40% of their money wiped out. And in the UK, for example, we still haven't recovered from March 2020 to a new high watermark. A lot of funds are way off their previous highs, and the opportunity cost and the lost opportunities and possible gains that could have been made in that period are significant. So this is just one very simple way of using indicators and stats in order to optimize our entry and exit positions. What I'm also going to look at is something known as the VIX index. I've referred to this before, and the VIX index is essentially based upon the S&P 500. It's a fear gauge. So if the markets are collapsing, fear's great and moves higher. If the markets are in steady state, the VIX index is fairly flat and low on its range. Okay, so what we're going to look at here is we're going to go back to March of last year, and you'll see very clearly that there was a fairly sizable spike. So in terms of the VIX index, it was hovering around the sort of 12, 13 level in February of last year, and then we saw it spike up in next to no time up to an index level of about 85, which from a percentage gains point of view is enormous. So what you'll see here is we have a negative correlation between the SPX and the VIX index. So the SPX is the stock market index itself. The VIX index is measuring how fearful investors are, and as the fear rises, as the market falls, if we're investing in this, okay, that allows us to eclipse the losses that are being made on the SPX in a very cost-effective manner. Now, when we're buying insurance, and this is what we're referring to here with the VIX, we're spending a very small amount of money, as we would with our life insurance, home insurance, car insurance, and we're hoping that we don't need it. So every single month we're allocating a small amount of resource out of gains that we've made to protect us from those big moves to the downside. Now these are very low probability trades because we very rarely have these events, but when they happen, we're very pleased we have this kind of cover in place. So we're spending somewhere in the order of about 0.25% per month to give us the peace of mind and the cover here, knowing full well that if we do see a massive move to the downside, this more than offsets it and swallows up those losses by often a factor of 2. So I go back to March of last year. A lot of the strategies that I were applying, the hedge cover made twice as much compared to what was lost in the underlying investment that we are involved with. That's for just one example. So, but here what we're trying to do is to put ourselves into a position where, on a like-for-like basis, we are protecting ourselves from those kind of moves and ensuring that we can make positive returns in a sort of evergreen or all-weather environment. Now, what I've just gone through here is just one tiny example. That they become more and more complex the deeper we dive into this, and what I propose to do over the course of the next few months, well, weeks and months, is to introduce more and more of these concepts so that you can see how we can move from more longer dated positions to shorter dated, because this kind of scenario takes a while to play out. We see various moving parts moving in different directions, and it's very difficult to value where we are in the whole scheme of things, and depending on where we are in this particular cycle. Okay, so what we will do over a period of months is to bring the longer dated positions shorter dated, to make them more transparent, to make them easily and more readily available to be valued, and I think a greater level of understanding will peel back the layers more in terms of what we're doing, because sometimes the complexity of an investment not creates uncertainty, but if you don't understand, just exactly what we're trying to achieve here, and the numbers and how that will extrapolate and play out over a period of time, it will not give you the sort of confidence that I can see through my eyes. I do see lots of turbulent times ahead. I see a big change in the macro picture, and from a market's point of view, if we do see a heightened level of volatility, we are well positioned because of these kind of situations and these kind of processes that we apply, that will allow us to sit back and enjoy the ride, as opposed to being fearful of losing significant sums of money if we do see nasty events come down the pipeline. The March 2020 was admittedly a rare event. Will we see more of these moving forward? Who knows, but we are protected and well positioned should that be the case. And for the small outlay per month that this kind of insurance protects, it's significant. I mean, protecting ourselves a 0.25% a month for a 40% drawdown is exactly where we need to be. And this works across all markets as well, so not just the S&P 500 or equity related investments, it covers everything else as well. So as I say, we'll go into more detail with other areas as well, and look at how we can take this insurance and create a position for free, in actual fact, without expending any of our gains or resources to protect ourselves against those big moves. So hopefully this will be of interest, he said hopingly, and we will pick up the same subject matter again very, very soon. Thank you for listening.